All right, perfect. So it's 4 o'clock Eastern on the nose. So we'll get things started. And once again, like every month, thank you for joining us for July's session of Making Sense of the Markets with Chris Kerlow and Team LWC. My name is Mitchell Shields, member of Team LWC, financial planner here in the office, and I'm just going to be kicking things off for today before we pass things over to Chris. And I'll be moderating the session throughout the day, or throughout the call. So today, there's a few things that Chris is chosen to focus on when it comes to this month's version of our webinar. He's going to be talking a little bit about the market resiliency amid rising uncertainty, talk about some of the defense win championships, stay in the game, he says, the impacts of higher for longer rates, and wants to talk a little bit about the potential bubble in AI. And I've been assured by Chris that he's going to do this whole presentation in English. And whenever he says something that's a little more technical, he's going to take a second to explain it. We'll hold the questions for the end. I'm going to be watching the questions kind of over here. So if you have any questions, just pop them in the question and answer box, and I'll make sure to address those at the end of the call. But without further ado, Chris, I'll pass things over to you.
Thanks, Mitchell, and thank you everybody for tuning in this month. It's been a fantastic start to the year, and there remains a ton of uncertainty as to where we go in the back half, and that's where we got our title, Glass Half Full Start, Glass Half Empty Finish, with a question mark. The TSX ended the first half up an impressive 5.7%, pales to comparison to the S&P 500, which was up 17%, and the NASDAQ up a whopping 32%. Posting another 6.7% gain in June. The TSX had a nice month, up 3.4%. So all that wraps up a great first half of the year. But with that behind us, the focus turns on to second half 2023. We're seeing the bond market and the equity market giving us signs of different opinions. So we use a variety of different leading indicators. Those are things that give us insight into the future. They're not always right, but when you pile them all together, it tends to give you some predictive analytics. What I'm showing here on the chart on the top right is the MOVE index and the VIX. The VIX is a more popular term. That's the measured volatility on the S&P 500. Basically, the amount the market expects the S&P 500 to move up or down in a day. It's not 13.54%. That's just kind of a gauge. But that number tends to go dramatically higher during periods of uncertainty and tends to go much lower during benign times. The highest we show here on that is about 30 back in October. You can remember that was a bit of a sell-off. And these numbers tend to happen in down markets, not so much up markets. The MOVE index is generating the same type of indicator, but on the fixed income market. You can see that these two tend to move lock and step, where a gap has diverted between both of them. People tend to say that the bond guys are always bearish and a bit smarter than us equity guys. So that's not the most positive indicator looking out there. But I'll just talk about a couple others that we're kind of looking at and give you kind of both sides of the coin. Another one is what I'm talking about here in the bottom chart, which shows the amount of people that are bullish, neutral, or bearish in a recent survey done by an American institute. That number has gone to extremely bullish. Bullish means people that are optimistic about the future. Bearish would be people that are pessimistic about the future. The difference between the two is now the highest since 2021. So although you may not be particularly positive, the general public is quite positive with where things are going. A big part of that is likely caused by two things. One, the S&P 500 is now in a technical bull market. That happens when it has moved up 20% from the recent low. A bear market would be the opposite, down 20% from the recent high, combined with the fact that inflation stateside has fallen from 4% roughly, from about 9% back in 22. We've seen similar declines here in Canada. This is all amidst declining stimulus. So stimulus is a tool that central banks use to help the economy. Markets tend to do quite well when stimulus is being pumped into the system. and not so well when it's being removed. And we're in that period of them removing. A lot of this comes from the Fed replenishing the coffers. They were indicating about 95 billion back near that debt ceiling debacle. That number's come in closer to 65. So again, expectations are really what we measure things against. Once everybody has an expectations, it's good as gold, and then it's about whether those expectations are met or not delivered. There are periods of time where the stock market does well during periods of declining stimulus, but that tends to coincide with positive economic growth. And that is not quite exactly what we're seeing out there in the world. You can see that if you're involved in the commodity business here in Canada or abroad, it's been a challenging year for commodities. This is their move down from their peak. See a large move lower in natural gas, actually a pretty good month in June. Oil down significantly, around $70 a barrel, back from about 110 a year ago today. Wheat, corn, meaningful moves lower as well. This is really helping bring down that inflation number. All of these things, as you know, wheat is the feedstock for the bread we eat, and anything kind of wheat based. Obviously, crude oil goes into everything from plastics to the gas you put in your car. So a lot of that is helping drive down these year-over-year inflation numbers from historically high levels last year. But those commodity price woes have been a byproduct of a lackluster reopening in China. We really didn't see the same bounce back that we saw here in North America for that economy, as well as elevated recession fears. That's really hurt the demand forecast for a lot of these commodities. So it isn't giving us as good of a bang for your buck in the decline of inflation. The Fed, as well as the Bank of Canada, would like to see that service side, which is such a big part of our economies now, start to wane. The jobs labor market's been done quite well. And then on the inflation side, we know all of that spending, that fiscal spending that was done during the pandemic and throughout and after, as well as the new Inflation Reduction Act in the United States, could provide some headwinds for inflation to fall meaningfully lower from here. However, falling commodity prices is good in the short term for margins for businesses because it translates to less cost of goods. You tend not to see supportive margins during an inflationary period, but we have seen that. And now we're actually seeing expectations of earnings kind of flatlining in the United States, where the amount of companies that are expected to have better earnings at the back of the year is equal to those that are going to have weaker earnings. It's still a little bit downward for the TSX. Part of that is based on the composition of our index, with a lot of banks and energy contributing to that. But the good thing for the TSX is it's trading at a much more attractive valuation compared to the states that have obviously had those aforementioned gains that I talked about at the start of the presentation. Manufacturing still out there is a big concern for us. It's in restrictive territory in most geographies. We've seen Germany, a manufacturing powerhouse, fall into a technical recession. That's 2 quarters of negative GDP growth in a row. And then inventories remain robust really across the globe. And if those get washed out, that again would put further pressure on the margins for these companies that we're following. The point of this slide of defense wins championships, stay in the game, is something I've talked a lot about in recent media appearances, as well as on Making Sense of the Markets, is the fact that market timing is a futile game. It's a fantastic way to destroy capital, trying to wait on the sidelines for the exact right moment to move in. If you are that type of investor, behavioral science would tell us that that's going to be the last time you would be interested in putting money to work, when it's the absolute worst. And if those moves come sharp off the bottom, maybe not everybody remembers how quickly the recovery came and how persistent it was following the pullback of March of 2020. Same type of rally following the 2008 recession. Missing those early parts can really destroy capital, particularly if you're taking money out as things have moved lower. So opposed to trying to be market timers, we're tactical asset allocators. What that means is we're moving money around constantly inside of your portfolios, going to where the puck is going, in our opinion, not where it was. We'll talk a bit about that on the tech trade. But another move we made this month was we disposed of a consumer discretionary name, Restaurant Brands. That's the owner of Popeyes, Tim Hortons, and Burger King. Recently, we also trimmed and got rid of a name, Canadian Tire, knows Canadian Tire, and we've been adding to the Canadian banks, which have been kind of thrown out with the baby in the bathwater from an episode with Silicon Valley Bank and other regionals in the United States, as well as just overall lending challenges that banks are facing globally, and been also added to a position in Nutrient. Nutrient's a large, if not the largest, fertilizer manufacturer in the world. The company is much more reliant actually on commodity prices than it is economic conditions. And our expectations are that those agricultural commodities that I showed earlier that have really come down and dragged this stock lower, the expectations we think are a little bit too frothy for the end of the year, and we think that should be a boon for Nutrient. The U.S. banks have done pretty well in the last few days following passing a stress test. We talked a lot about the fact that we have a U.S. bank position. The difference we actually made in that trade in March was we added to the position and we hedged our currency exposure. Fortuitously, as the Canadian dollar has rallied to a 3-year high recently, following a bit of a surprise rate hike from the Bank of Canada. So we've hedged that position. We've also hedged a position on the global side that I'll talk about later in the presentation. And we think that the Canadian dollar in a recovery on the commodity side still has some room to run as well. We think that the Bank of Canada will likely keep pace with the U.S. Federal Reserve. Rate hikes are interest rate parity. That's one that I'll probably leave out of the educational section, but something that impacts currencies is how much you can borrow and lend for in a specific country. The higher the rate tend to go, the higher the currency. So if the Fed hikes faster than the Bank of Canada, that would not be good for the Canadian dollar, but that is not what we expect. But longer term, the US dollar does have some structural issues. It was formerly 71% of the global market. That's fallen to 59% over the last 2 decades. So a declining trend that we expect to continue to decline. And then it used to be exclusively used for settling commodity trades in oil and natural gas. We've now seen alternative currencies used in those settlements. And obviously the rise of alternative currencies, generally speaking, with maybe a possible currency coming from the BRICS nations and good old Bitcoin drawing a bit of that flight to safety characteristic. However, should we get a pullback, we do think the USD probably does bounce back a little bit off this short-term pullback. So what are the impacts of these higher rates for longer? We saw the Fed kind of reiterate that they expect 2 more rate hikes this year, and they don't see, those coming down at any point in 2022, 2023. It's about an 82% chance the Fed tightens at their next meeting. That caused actually a decline in the U.S. Treasury. And this is obviously a challenge for the housing market, higher borrowing costs. Sales to new listings remains fairly low. And so that should be negatively impacting prices, but it has actually not hurt Canadian housing quite as much. Housing prices rose 2.1% on a month-over-month basis in May. Pretty encouraging that the Canadian housing market's bouncing back. And anecdotally, I'm sure a lot of you are kind of seeing that in your day-to-day lives and discussions with your neighbors in your neighborhoods. Household savings actually started ticking up in the U.S. while continuing to decline here in Canada. as consumers are getting off some of those savings built up. That has been one of the things that people cite as propping up this market, is that pent up savings from the pandemic. In Canada, we're also seeing record immigration, higher than the 2016 record. And so that's also helped our economy remain resilient, but we are a bit more sensitive to the rate hikes than our counterparts stateside, because we have a shorter mortgage term, generally speaking. In the United States, you can take 30-year fixed rate mortgages, which a lot of people did when rates were closer to zero. So less impacted there, a little more impacted here in Canada. Now, this is time for the fun stuff. We've had a few clients talking about the AI bubble that, in my opinion, is brewing. This is something that we've seen in technology back in 2000. We saw it in cannabis back at my predecessor firm. It was a euphoric time for funding companies based on funded capacity to grow cannabis, despite the fact that there just wasn't that much more demand behind it. And then we saw it in 2001 with the rise up in Bitcoin and the inevitable pullback. All three are great examples of what we see happening here in artificial intelligence. It's not that this is going to be transformational new technology. It's fantastic, the things that these applications can use. If you haven't used ChatGPT, I challenge you to give it a try. It's quite powerful and cool in what it does. But all of these trends have very similar characteristics and tend to kind of get ahead of themselves. And we think that in some of these names, we could be in that bull trap area highlighted here, where you're kind of getting this really, really fast run up in this public market delusion of greed. Artificial intelligence has been something people have talking about for a long time. Us as institutional investors tend to get into these trends earlier than most. That's really what our job is. We purchased a small $1 trillion company called NVIDIA back in October for about $100 a share. It's close to 4 times that now. We still have a small position, but as disciplined investors have been taking profits along the way. I'm happy to tell all of you and most of you that we also own a fund called the Fidelity Global Innovators Fund. The name kind of describes it. The portfolio manager, Mark Schmel from Fidelity, is one of the best in the business. I've been covering him for most of my career. He is a savant and is extremely well-versed at identifying the haves from the have-nots. As you can imagine, the technical aspect of artificial intelligence is quite challenging. From doing a little bit of Python training years ago on learning machine learning, which is essentially what a lot of people called artificial intelligence leading up to this year, where now it's generative AI. We're still not there where code is writing code. That would be really what people would call artificial intelligence. And that's where you get this regulatory overhang. But you can see these common ingredients of a bubble: easy money. If you have anything that has AI in the name, companies are throwing money at it. They can lever up their balance sheet. Regulations coming in. It's newer disruptive technology, and it's gone global. And on top of that, that's when you get this broad market speculation. So with that, I'd like to just give you a quick quote from Robert Shiller, Nobel laureate and one of my favorite economists of all time, really the godfather of behavioral economics. Basically defines a bubble as a situation in which news of price increases spurs investors' enthusiasm, which spreads by psychological contagion from person to person, in the process amplifying stories that might justify the price increases and bring in a larger and larger class of investors, despite doubts about the real value of an investment. And so that's really where you can be exposed to that capitulation trade, shown kind of on this drag down, to where you kind of get back on trend, and the great companies that are changing the world are good buying opportunities once again. We saw that back in October when we added 2 positions, like NVIDIA, like Uber. Uber, you may not think of as an AI company, but really big tech aspect to that organization. And they've kind of pulled up higher here. We are tactical asset allocators, so although we still own positions in them, we have pared those back. We continue to remain long the trade and trust in Mark at Global Innovators to pick the winners and move out of the way when things get frothy. So with that, I'll pause there, and hopefully that was insightful and helps some of you ease that FOMO trade, watching the NASDAQ rip 38% or 36% in the first 6 months of the year, and know that we're picking that up. This is the Global Innovators is up 25% year to date. It's a global mandate, so not just the NASDAQ, it really goes around the world. Really good start for Mark, and happy to have that in most of your portfolios.